Wait, hold up. Tom Lee's October outlook is a little interesting. In this video, you will get a clear path on how to position and also what role NVIDIA may play in this pending year-end rally. Let's take a quick look at this video from Tom Lee. And before we start, this video was brought to you by NVDIA Tax, so click on the link below for the Instagram link for some free tax tips.
The positive tailwinds into year-end, he says, are stronger than the headwinds. Joining us today is Tom Lee, Fundstrat Global Advisors Managing Partner, a CNBC contributor. Hey, Tom, good to see you.
Hey, Carl, how are you?
I'm good. What do we make of the market in light of the jobs number and a VIX, which I know you're watching, but is still close to 20 today?
Yes, I mean, I think we're in a tricky period because there are these sort of complications, which is geopolitical risk. We've got the port strike out of the way, and I know October has these seasonals. I think it's very good news to see the stock market react positively to a jobs report because it is, in fact, a good report showing the economy is actually not only holding up, but the unemployment rate's down. But I agree with you. The VIX is important to tell us how much we could rally. I know our head of technical strategy, Mark Newton, thinks that we're making intraday lows today, and it's setting up for us to make new highs next week. I mean, to me, that makes sense just because it has been a resilient economy, and then next week we get CPI. But I do think it's hard to say this is a green light into year end because, as you're pointing out, the VIX is just staying stubbornly high.
Tom, we've seen some changes in the swaps market with regard to expectations for future rate cuts, at least in terms of magnitude. How does that alter the calculus, if at all, for the equity markets? If it is now looking more like a 25 basis point cut in November instead of 50 basis points in those weightings changing, does that impact expectations in the equity market, or that's not really priced in at this point in time?
Well, we know that Fed fund futures and expectations about the magnitude of cuts over the next couple of meetings does affect the bond market. And we're seeing that reaction today. And, of course, I'm even seeing some folks think the Fed made a mistake with 50. But for the stock market, I think what matters more is really the Fed. The Fed is actually in an easing cycle, and we're making our way towards neutral. And so I think that there is going to be times where the stock market, where the S&P is going to rise even if yields are up. I think we're in an instant there because yields can be rising because the economic data is better, and so we're kind of rising for good reasons on yields, and I think that's supportive of stock. So I'm not too bothered if the odds of a 50 have dropped today because of a good jobs report, because I don't think it means the Fed is suddenly backpedaling and back to hiking mode.
On China, Tom, is it good for global growth? But how is it offset, if at all, by any kind of drains to liquidity or just the rush of hot money to either cover shorts over there or try to play along with this?
I think on balance, it's very good news that China's PBOC and the government have launched a bazooka series of measures because it has been, on a relative basis, a drag not only on the global economy, but a huge underperformer for the past 10 years. I don't think U.S. investors are selling their U.S. equities or even small cap stocks to buy China. I think it's coming out of all this cash on the sidelines. We know margin debt hasn't moved for 4 months, and it's still way below the 2021 highs of $936 billion. And we know there's $6 trillion cash on the sidelines. So I think this is motivating money into action, but it's overall, I think, a positive.
Based on Tom Lee's perspective, it's best to stay invested but be cautious on buying additional stocks and wait for an opportunity to buy the dip. Only because election time could be a bit volatile for markets, so until we figure out who the president will be, we just can't jump in head first and write the S&P 500 to 6,000. Now, let's take a look at this article from Barron titled, "The Stock Market Looks Very Strong, Prepare for the S&P 500 to Hit 6,000 Soon." This year has featured traders eager to gobble up the next dip. Right Cap Thesis founder says everyone is aware of the dynamic, nobody wants to miss out on more gains, which only encourage more buying and continued gains. The technicals are very strong, says Mahoney Asset Management, Ken Mahoney, who bought more NVIDIA this week. It's understandable that some folks will want to hold off and jumping in now, but those who have already been in the market for quite some time might as well consider staring in and riding another potential rally through the end of the year. Before buying anything, please do your research. Don't forget to like and subscribe to the channel and click on the link below for some free stock from Rebull and Moomoo. Thank you for tuning in and see you next time.